Credit card welcome offers are getting bigger, but so are the spending requirements. $10,000, $12,000. In 6 months, the bonus looks amazing, but is it actually worth it? Today, we're breaking down the real math behind high spend welcome offers and how to decide if they make financial sense for you. High minimum spend credit card offers. You've probably seen them. 80,000 points, 100,000 points, but spend $10,000 in 6 months, or even 12,000. That sounds simple. But the math underneath it is not. Let's start with the basics. When a card requires $10,000 in spending, that is not free. That is liquidity. That is cash flow. That is opportunity cost. So step one is simple. Can you naturally spend that amount without changing your behavior? If the answer is no, stop right there. Manufacturing spend with interest charges destroys the value of any bonus. Now let's assume you can hit the spend organically. The next question is valuation. Let's start with example number 1, $10,000 spend requirement, 100,000 point bonus, 2 times earning, $395 annual fee. When you run the numbers conservatively, including base earnings and valuing points at 1.5 cents each, the net return after the annual fee comes out to roughly 14% on required spend. That's strong. Now let's analyze a larger offer. $12,000 requirement, 80,000 to 175,000 point bonus, 1 times earning $895 annual fee. Here's what happens. In the low tier bonus scenario, after base points and subtracting that high annual fee, your return lands around 4%. That's tight. In the high tier scenario, if you qualify for the full elevated bonus, your return jumps to roughly 16%. That's strong, but only if you actually hit that top tier. Now, let's address the trend. Issuers are increasing spend requirements because consumer spending is strong. They want bigger engagement. They want deeper wallet share. And they know many consumers won't fully optimize redemptions. That's where you win. If, and only if, you calculate correctly. Now let's talk liquidity risk. If your floating balances, if your income fluctuates, if you rely on short-term buffers, a $10,000 or $12,000 requirement can create stress. And financial stress cancels out reward value. Rewards are leverage tools. They should never create fragility. Here's the strategic way to approach high spend offers. Step 1, map your next 6 months of real expenses. Insurance premiums, business expenses, planned travel, tax payments, large recurring bills. Step 2, confirm those expenses naturally exceed the threshold. Step 3, value points conservatively, not aspirationally. Step 4, compare against alternative bonuses available right now, because sometimes 2 mid-tier bonuses outperform 1 massive one. So are high minimum spend offers worth it? Only if 4 things are true. 1, the spending is organic. 2, you apply conservative valuations. 3, you subtract annual fees honestly. 4, you have clear redemption intent. If all 4 align, high spend offers can be powerful. If you're stretching to justify it, they become expensive distractions. Big bonuses attract attention. Efficient bonuses build wealth. And in this space, math always wins. If your paycheck isn't predictable, your money system shouldn't be either. This is finance built for variable income. I'll see you in the next one. Thanks for watching The Irregular Income Economy.